I've been running the fund since March 2011, running it with exactly the same investment philosophy and process. And really, I've just been looking at companies that I genuinely believe can sustainably increase their economic output and where balance sheet strength is supportive of that growth. My fund I've run has been diversified. I view equities as risky, so 60 to 90 holdings. Being an equity investor, you need to be patient. So my investment horizon has been 3 to 5 years. In reality, a lot of holdings I've had, I'll hold for much longer than 5 years. And at the moment, the average holding period is 7 years. So there's no big turnover in the fund. And what I felt a real key to success, I mean, if you look at the sort of constituents of outperformance of the index, for example, it's come from stock picking. But I think that underestimates the work I do on the strategy. And what I mean by that is finding companies that are operating in areas where there are economic tailwinds. And an example of this, you think back to a quote from Henry Ford's lawyer back in 1903. He said that the horse is here to stay, but the automobile is only a novelty, only a fad. And that's interesting from two perspectives. One is that experts can get things very wrong. But what it also tells me is it doesn't matter in 1903 how good you were at renting out, owning horses, your business ultimately was going to be destroyed by the car. So it's all about getting behind the headline numbers, stock picking, finding those businesses with those economic tailwinds. And that's what's driven the performance of the fund fairly consistently since launch. What we've seen typically is an acceleration of what we were having before. So incremental speed and growth of internet retail, companies deploying technology even faster to give them a competitive advantage, and some other sort of interesting nuances around the edge as well. More and more of us are working from home, and I think what companies are realizing is that they don't need to just recruit employees in the local vicinity. So companies like Telecom Plus, for example, which is held in the fund, it's a utility provider. They no longer feel that they need to staff their call centres physically and using people in a particular location in North London. They are happy now to start recruiting from further afield. And as a consequence of this, you're seeing companies looking to recruit nationally. That can take shortage of labour issues out of the equation, and also helps companies to manage the cost base in terms of the amount they're paying for their employees. So for a variety of reasons, one of those being this dynamic, changing way of employing people led to me taking an investment in Telecom Plus in the Mid Cap fund. I've been involved in a fundraising for Rank, which owns the Grosvenor casinos and has an online offering as well. This is a company that generated over £200 million of EBITDA before the crisis, but because Grosvenor casinos, their physical estate has been closed, that's led to a dramatic fall in the profitability of that business and a commensurate fall in the market capitalization as well. So that's a business that became particularly cheap as a consequence of closing. However, because it's closing, it was running up significant losses and needed recapitalizing. Now, it now has a recapitalized balance sheet and still has the potential, I think, once the world returns to some sort of normality, and by that I mean people have a chance to congregate, meet, go out, go back to enjoying experiences, has a chance for its profitability to grow back towards where it was in 2019. I mentioned Pets at Home earlier. That was addition during the very tough periods in 2020. That's become a top 10 holding within the fund. And it's a holding I'm committed to as well. One other example, Chemring, a defence company. Very often in the UK, people get slightly down on the tech sector. We don't have the same tech companies that the US market has. However, I think that understates the technology companies that sit within other businesses, and within Chemring there's a fantastic business called Roke, which has a market-leading cyber security offering, but also companies are using technology to make themselves a lot more efficient and effective as well. And that, if those companies are supplying into supportive growing end markets, can only be beneficial ultimately to the equity holders. So we remain very excited about these holdings, and we continue to look. We're seeing a big uptick at the moment in the IPO market, so I think that gives potential opportunity going forwards as well. Yeah, I think on the whole, people, me included, are more optimistic from an economic perspective than we were a year ago. I mean, the vaccine, as it stands, on the basis of the knowledge we have, is going to make a massive difference. This is certainly a game changer. Now, in terms of investing and trying to time the market, of course, economic recovery is going to be linked to a certain degree to the success of the rollout, and that's the speed of the rollout. And also the success of it on an enduring basis. And because it's going to have to cope with mutations of this virus, which we're seeing at the moment. Speaking to our biotech team, they're very confident that the new mutations we're seeing will not be resistant to the vaccine. So we remain optimistic that the economy will continue to open up. And the banking system, which is well capitalized, has been supportive of this growth and is supportive of companies' need for capital, which they've needed, particularly in areas like hospitality, where turnover has fallen dramatically. Banks are also there to support businesses, and that gives us a cause for optimism, certainly from an economic perspective. What I would say, as a fund manager and a stock picker, you just need to be very careful how much debt your companies have taken on through the downturn, and how that change in the financial structure will impact the fundamentals of the business going forward. Don't forget, as an equity holder, we are the least preferred creditors, so balance sheet strength remains really important.